Can you remember the feeling a few years after the 2000 and 2009 bubbles burst, looking back and thinking it was obvious we had been in a bubble? Let's look at a few charts and a few ideas about where we are now. Are we like 1998, 1999, or 2000, right before the burst? The stock market and the economy move in cycles, and we tend to exaggerate both the highs and the lows. This is a strong recurring pattern. Look at what happened in Japan around 1990. I'm not claiming we've reached the same level of craziness the Japanese market hit in 1989, but the trend in US stocks is still strong, and maybe it's impossible to estimate exactly how high we can climb. Briefly, what preceded the 1989 peak of Japan's stock bubble? Monetary easing, speculative behavior, and speculation across many assets. Then came the crash and the lost decade. In 2024, something big happened. After 35 years, the Nikkei 225 finally surpassed its 1989 peak. Congratulations! Now the Nikkei is flying. Another approximately 10% could put it near the same inflation-adjusted level it reached in 1989. Lost decade or lost 3 decades? Yes, this time is definitely different. Policy became far more expansionary after 2009. And by the way, what was one reason we started quantitative easing in 2009? One big aim was to avoid a Japan-style deflationary slump. Okay, every cycle is a bit different, but cycles are a strong recurring pattern.
Patterns matter, and AI itself is pattern-based, so let's talk AI. After more than 20 years in markets, I know I can be wrong. I rely on probabilities, and nothing here is investment advice. What I'm offering is the perspective of a small investor and former programmer who also looks under the hood of AI. See my earlier videos. I believe the world will look very different by 2030 thanks to AI, but I definitely see some risks to the high profitability that's expected from the winners of the current AI race. In my view, today's gigantic capex isn't only about future profits, it's more about securing a future position among AI winners. It feels like a battle of attrition. Whoever pays the most secures the resources, and only a few brutally overpriced companies like NVIDIA are truly profiting from this dynamic now. The hardest problems may indeed be solved by the ultimate winners, but I think a second, cheaper wave of AI providers, those who avoid massive capex, can still make money on everyday enterprise use. We already have open-source models that, with solid RAG grounding inside company domains, can take over simpler workflows. Not everyone will need the most advanced and most expensive AI if slightly less powerful, much cheaper services are available. There's also the US-China race for AGI. In prior videos, I explained why, unfortunately, China and India may have meaningful advantages in AI over time, and China is already keeping pace at lower corporate cost. A heavily state-supported Chinese AI sector raises real questions about the long-term profitability of Western AI leaders. The winners of the AI run may face strong competition, and the future profitability of today's leaders may not match their current valuations. Some analysts justify the stock market's rise with earnings growth from AI leaders. Keep in mind, the dominant share of today's huge capex will be depreciated over future years, not this year. Continued model scaling also likely depends on further hardware improvements, so these capex waves probably aren't the last. The recent deal flow between OpenAI and NVIDIA, and between OpenAI and AMD and others, raising many questions, could even be an early sign of exhaustion. Gareth Soloway, Verified Investing, said that 50% of US GDP is now connected to AI. I couldn't verify that extreme number or how he calculated it, but I have no doubt AI is a major driver of the current US economy, and our risk may be as simple as a slowdown in AI capex growth. I'm not claiming to decode everything, I'm framing it in probabilities. My bottom line, today's AI leader valuations don't fully reflect the uncertainties and risks. And yet, I repeat, I believe AI will change our world in the not-so-distant future, perhaps more than we realize today.
Let's talk about liquidity. Michael Howell of Cross Border Capital posits that the primary engine of global asset markets is not classical macroeconomics, but the flow of global liquidity, which he defines as the dynamic capacity for credit and financing, not just a static monetary aggregate. He argues the current supercycle rests on two pillars. One, the supply of reserves from central banks, directed by treasury bill, bond mix, and cash balances. And two, the even larger secondary layer of credit created against collateral. High-quality collateral, particularly government bonds, underpins the repo market, allowing initial cash to be multiplied into a vast credit wave that lifts asset prices from stocks to crypto. Howell estimates this wave will peak in late 2025 to early 2026, with the turning point being the approaching maturity wall, a large wave of debt maturities. Between 2026 and 2028, the need to refinance trillions in low-rate era debt will act like a sponge, soaking up available cash from the system. At the same time, increased stress could worsen conditions in the bond market, reducing the value of the collateral the system stands on and triggering forced deleveraging. This dual pressure on both cash and collateral is, in Howell's view, the mechanism that ends the expansionary phase of the current cycle, shifting markets from easy gains to a period of heightened stress and volatility. Another factor is private credit. Non-bank lenders have surged, but much of that growth is in riskier, floating-rate credit with weak covenants, vulnerable if rates stay high. Commercial real estate faces a harsh refi wall. Higher yields and soft fundamentals, especially offices, push losses toward regional banks, CMBS investors, insurers, and private funds. With delinquencies and bankruptcies drifting up, the system's growing reliance on opaque, less regulated credit channels raises the risk that a slowdown turns cracks into broader stress.
Let's take a look at a few charts. First, the U.S. federal debt. Are there many optimists here? Next, a comparison of the S&P 500 and the M2 money supply since 1996. We're flying pretty high, but with a little bit of craziness, there could still be some room to the upside. Unemployment rate, not a booming economy. Building permits, not a booming economy. And this is a very amateur, messy comparison of the Nikkei 225 and Japan's money supply since 1980. But the important thing is that few people today can imagine this, M2 flying up and the markets going down. Okay, let's try to draw some conclusions. Once again, this is not investment advice, just my personal take. I can definitely see a stock market bubble forming right now. Interlocking deals between AI leaders create circular revenue, making the company's growth appear much stronger than it actually is. I don't believe anyone can predict the market in the short term with high probability. But if we look at past big bubbles, there may still be room for an overshoot, maybe even a fast S&P 500 move towards 7,500. For me, that would be the confirmation of the bubble, and I would add to my short positions on the S&P and NASDAQ. For now, I'm 53% in cash with an initial 1% short on the S&P and NASDAQ. This bubble isn't going down without me. Ideally, I'd want to see a big crack in liquidity or some other clear down signal after a major overshoot past 7,000. That would be my cue to seriously increase my short position. I have one wilder technical theory about how this bubble could implode. Lately, we've gotten into this habit where, on any small dip, many investors buy put options to hedge. And, frankly, it's been working. It usually reduces the selling pressure. I think this pattern will hold until a real trigger comes along. At that point, the dynamic will reverse. The sellers of those put options will be forced to accelerate the decline by shorting the underlying assets to hedge their own positions. I also have a scenario for where I could be wrong. AI is a critical strategic issue for the US, and the risk of China taking lead is a major threat. So, I can theoretically imagine the US accelerating its debt issuance even further, all in the name of supporting the AI sector, which would just add more fuel to this bubble. Now, theoretically, that should have a negative impact on the long end of the bond market, pushing yields up and draining liquidity. But in this environment, who can really figure it out? Jason Shapiro has a good definition of a bubble.
A bubble is a market where I'm not long. Jason warns against shorting right now, and he's probably right. Let me finish with one recent story. A friend of mine called me. He's been in the market for about a year now, of course. He didn't know the word diversification and, thanks to social media, is fully loaded into AI. Worse, he's confident he can ride out any drop because he knows it will bounce right back. After all, there's inflation. And there's those absolutely safe index ETFs. By the way, does that remind anyone of the absolute safety of mortgage-backed securities and other products before 2008? Unfortunately, I'm also starting to see a parallel between today's growing AI circular revenue system and the Japanese keiretsu structure that preceded their lost decade. For me, now is the time to listen to people like Ray Dalio, who correctly points out that we are rarely surprised by the things that have happened in our lifetime, but by the things we have never experienced before. So, good luck to everyone. My philosophy is to be positioned in a way that lets you sleep peacefully at night. If you enjoyed the video, please like and subscribe. If not, subscribe anyway and be as happy as possible.
Please. I just got fired from my job. They say bears won't be needed on Wall Street anymore.